56% of Americans cannot cover a single $1,000 emergency expense. Not a medical bill, not a car repair, not a broken furnace in January, just $1,000. And here's the part that should scare you: that number hasn't gotten better in years. It's gotten worse. Today, I'm going to show you exactly how much you actually need in your emergency fund in 2026. Why the old rules are completely wrong, and the fastest way to build one, starting with whatever you have right now. Let's get into it. Welcome back to Money Made Simple, where we break down U.S. money topics in plain English. No jargon, no fluff, just what actually matters. Hit subscribe if you're new. Let's go. Here's a situation that happens to real people every single day in America. You're driving to work on a Tuesday morning. Everything is normal. And then your check engine light comes on. You pull into a mechanic. The diagnosis? $1,200. And just like that, a completely normal Tuesday has turned into a financial emergency. Do you have that money sitting somewhere safe and ready? If you said no, you are not alone. And you are not bad with money. You just haven't built your safety net yet. That's exactly what this video is for. But here's what makes 2026 different from any other year. Layoffs are happening across every industry. AI is replacing jobs faster than anyone predicted. Inflation hit your grocery bill, your rent, your utilities. And the job market is the most unpredictable it's been in a decade. An emergency fund isn't just a nice thing to have anymore. In 2026, it is your single most important financial move. More important than investing. More important than paying off debt. More important than anything else on your financial to-do list. You've probably heard the old advice: save 3 to 6 months of expenses. That rule was created decades ago when most people worked stable 9-to-5 jobs, stayed at the same company for 30 years, and could find a new job within weeks of losing one. That world doesn't exist anymore. In 2026, the average job search takes 4 to 6 months. Some industries, tech, finance, marketing, are seeing layoffs with severance packages that run out before a new offer comes in. 3 months is no longer enough for most people, not even close. But here's the other problem with the old advice. It tells you how much to save, but it never tells you how to actually get there. Most people here save 6 months of expenses and think that's $20,000, and then they do nothing. Because $20,000 feels impossible. Today I'm going to change that. Because the goal isn't $20,000. The goal is your first $1,000. And I'm going to show you exactly how to get there. Now, before I tell you the exact number you need, I need to show you something that most financial advisors never talk about. Because the answer to how much should I save is different for every single person. And getting the wrong number could leave you either dangerously underprotected or saving money you don't actually need to save. Stay with me. This part changes everything. All right, here's the honest answer to how much you need. And the honest answer is it depends. But not in a vague way. In a very specific way, based on 4 things about your life. Factor 1, your job security. Ask yourself honestly, how stable is my job? If you work in healthcare, government, or education, you have high job security. 3 to 4 months of expenses is probably enough. But if you work in tech, media, marketing, real estate, or any industry being disrupted by AI right now, you need 6 to 9 months. Minimum. Because your next job search could take that long. Factor 2, your income type. Do you get a regular paycheck every 2 weeks? Or is your income variable freelance work, commission sales, tips, contract work? If your income varies month to month, you need a bigger cushion. Not 3 months, not 6 months, 9 to 12 months. Because your emergency might not be a car repair. It might be a slow month where the clients didn't come through. Factor 3, your dependents. Are you single with no kids and no one relying on your income? 3 to 4 months might be fine. But if you have a spouse, kids, elderly parents, or anyone else depending on your paycheck, you need more. Because your emergency doesn't just affect you. It affects everyone in your household. Factor 4, your fixed expenses. Do you rent a small apartment and drive a paid-off car? Or do you have a mortgage, 2 car payments, and private school tuition? The higher your fixed monthly expenses, the more months you need saved. Because when income stops, those bills don't. So here's the simple version. Single, stable job. No dependents, save 3 to 4 months. Married with kids, variable income, or working in an unstable industry, save 6 to 9 months. Freelancer or self-employed, save 9 to 12 months. Write that down. That is your real number, not some generic advice from 1990. Now here's where most people get stuck. They know how much they need, but they have no idea where to actually put the money or how to build it without feeling like they're sacrificing everything else. Because there's a right way and a wrong way to build an emergency fund, and most people are doing it wrong. Let me show you the right way. Okay, here's the practical part. How do you actually build an emergency fund? Step by step. Step 1. Open a separate account. Do not keep your emergency fund in your regular checking account. If it's mixed with your spending money, you will spend it. Open a completely separate savings account and name it Emergency Fund. When you see it labeled separately, your brain treats it differently. Step 2. Use a high-yield savings account. This is critical. Your regular bank probably pays you 0.01% interest on savings. That means on $10,000 you earn $1 per year. $1. Meanwhile, high-yield savings accounts at online banks like Marcus, Ally, or SoFi are currently paying around 4%. On that same $10,000, you'd earn $400 per year just for keeping your money there. Same money, same safety, 400 times more interest. Open one today. Step 3. Automate it. The biggest mistake people make is trying to save whatever is left over at the end of the month. There is never anything left over. Set up an automatic transfer on payday. Even if it's $25, even if it's $50. The moment your paycheck hits your emergency fund, gets funded automatically before you can spend it. You will not miss money you never see. Step 4. Hit $1,000 first. Forget the full 3 to 6 month goal for now. Your only goal today is $1,000. Because $1,000 covers most common emergencies: a car repair, a medical copay, a broken appliance. Once you hit $1,000, you have officially left the most financially vulnerable group in America. That first $1,000 is your foundation. Build from there. Step 5. Don't touch it. This sounds obvious, but it's the hardest part. Your emergency fund is not a vacation fund. It's not a "I really want those shoes" fund. It is for genuine emergencies only: job loss, medical bills, urgent car or home repairs. If you dip into it for non-emergencies, replenish it immediately. Every time you use it, refilling it becomes your top financial priority until it's back. Now I want to talk about the single biggest mistake people make with emergency funds, because this one mistake wipes out years of saving in a single moment. And almost everyone is guilty of it. Here it is: keeping your emergency fund somewhere you can't access quickly, or somewhere you're tempted to invest it. I see this constantly. People put their emergency fund in index funds or stocks because they want it to work harder. Here's the problem. When a real emergency hits, the stock market might be down 30%. You withdraw your money at the worst possible time and lock in those losses. Your emergency fund is not an investment. It is insurance. Keep it boring. Keep it liquid. Keep it in that high-yield savings account where it earns 4% and you can access it within 1 business day. Never invest your emergency fund. Quick recap. 56% of Americans can't cover a $1,000 emergency. The old 3-month rule is outdated. Your real number depends on your job security, income type, dependents, and fixed expenses. Open a separate high-yield savings account. Automate your contributions. Hit $1,000 first. And never ever invest your emergency fund. Do these things, and you will never be part of that 56% again. Guaranteed. Now I want to hear from you in the comments. Do you currently have an emergency fund? And if yes, how many months do you have saved? Drop your number below. I read every single one. And if this video helped you, hit that subscribe button so you never miss another money breakdown like this. Check out the video on screen for more ways to protect your money. See you in the next one.